The first meeting is really a get-to-know-you meeting. We're going to sit down. Typically, the meeting will last about an hour. We're having a conversation. My job is to ask them some questions about where they are, what some of their goals are, what some of the key objectives they have in meeting with me, where they are to this point, and really what brought them in to see me. And now I'm at the point in my career where I have a lot of people that are dependent upon me to provide them with all the guidance and all the advice that we do on a day-to-day basis.
You spend your working years trying to build up your assets, trying to build up pension credits at your job, trying to grow your nest egg so that you can one day retire when you can't work or don't want to work anymore. And that's a period followed by phase two, which is retirement. And your priorities in these two phases are very different, but many times we see people don't make that shift and they still act like they're in phase one when they really should be acting like they're in phase two.
We're going to talk to you about what we commonly refer to as the second half of the game. And what I mean by that is you're working your entire life towards retirement, and I'm assuming that most of you are, at that age where you're starting to consider some of your options as you move into retirement. And as you do that, you're moving from what we call the accumulation phase of your life, where you're accumulating your assets. Maybe you're participating in your company's 401k, maybe you're contributing to an IRA account or a Roth IRA account or some type of retirement vehicle. And now, as you retire, you're transitioning into the distribution phase, or the part where you're going to need income in retirement. So we're going to talk about some different ways to do that with an emphasis on Social Security.
Hello, I'd like to welcome you to Financially Speaking with Jeff Bush. My name is Steve Jablonski, and I'm the host for today's show. We'll be talking about life insurance today and its different purposes throughout one's life and how it can change when you're younger to when you get older. So with that said, Jeff, I'd like to introduce you to today's show.
Well, thank you, Steve, and welcome to the show. It's certainly it's great to be here on PCTV. We've been doing this show now going on 4 years, so we love being here in the studios here of PCTV right here in Pottstown High School. And of course, one of the reasons why we've done this show is because not only are we able to put this show out on PCTV, but also the PCTV website, which is thepctvnetwork.com, and also our website, which is informedfamily.com. So it gives us kind of a global presence, if you will. So great to be here. Great to talk about life insurance, which is certainly one of my favorite topics, because that's how I started in this business, was by helping families with protection through life insurance.
Now, Jeff, life insurance can be confusing to some people, some clients. And if we really simple it down a little bit, what are the couple kinds of basic insurances, and then we'll get into them a little bit more.
Yeah, so life insurance can be very complicated, and I think what we want to do today is make it easy and simple for people to understand. So we have, in its most basic form, you have term life insurance, which doesn't carry any cash value, and then you have some of the more advanced types of life insurance, the permanent, what we call permanent life insurance, whether it be universal life or whole life or variable universal life. These are all types of products that carry cash value.
And I've heard some people really refer to term as renting, like renting a house, versus permanent owning. So why would someone choose term?
Well, because for a lot of reasons. Okay. It's inexpensive to begin with relative to other types of insurance. So term insurance, as the name implies, insures you for a term.
Okay.
So that could be what's very popular is level term insurance. So you go out and you buy a 10-year level term or 20-year level term. What that means is the premium you pay or the price that you pay for this insurance is going to be the same for that 10-year period of time. And then after the 10 years is up, the insurance is basically gone. So you're insuring yourself for a term, I think a relatively short term.
Okay.
And the reason why it's relatively inexpensive is because there's a relatively small, you could even say minute, chance that the insurance company is going to have to pay a death benefit. So that's why, and that's why you call it renting the insurance, because it's not really, it doesn't really carry any cash value. But a typical example of the need, or why you would buy term life insurance, is because you may be young, you may have a lot of debt, and you need to cover your life. You need to cover the potential income that you would be losing in the event of a premature death. So let's say you're 30 years old, you just bought a house, you have a great big mortgage, you want to buy life insurance. So you buy term life insurance. Maybe you buy term and life insurance to match the term of your mortgage.
Yeah.
So you bought a 30-year mortgage, maybe you can get 30-year, and they do sell it, 30-year term insurance.
Yeah.
So that protects the mortgage at a relatively inexpensive price. And then when the term is up, it's gone.
Can you continue it at all, or is it just totally?
Well, you can, but you don't want to.
Okay.
Because what happens is the year after the term is up, okay? So let's say you buy a 10-year term policy. In year 11, there is a guaranteed rate that is it's cost prohibitive.
Okay.
Nobody ever wants to pay that premium. And the only time you ever would is if you're gravely ill. If you have a terminal condition, then it might make sense to buy it. Otherwise, your insurance is gone, and if you still need insurance, you buy new term insurance.
Okay.
It's funny. I can give an example here. Business owners. I insure. It's a family of 4 siblings, and we got them 10-year term insurance for their business 20 years ago. Okay. So we got them 10-year insurance. The 10 years were up. Then we got them another 10 years, which got them, just to this past year, we got them insurance again. So I've given them 3 separate 10-year policies, but it served a purpose of the bit. Actually, their business agreement calls for life insurance.
Okay.
So they have to have the life insurance in terms of their buy-sell agreement, their business agreement.
So if we move into permanent insurance, what's that look like?
Well, if you're going to use the analogy of term insurance, you're renting the insurance. So with permanent insurance, you're buying the insurance.
Okay.
So it's a different ball game. It's a complete different ball game, and a lot of people don't understand the benefits of buying permanent insurance. And basically, what you're doing is, and there's all kinds of reasons and all kinds of applications of why you would buy permanent life insurance. And we, of course, as our practice has evolved over the years, we've done a fair amount of life insurance, permanent life insurance. Steve, you and I just worked on a pretty involved case, just a few months ago. Although it seems like a few years ago because it kind of drug on for a little while, which can happen because it's complicated. But permanent life insurance, as the name implies, is going to be, it's going to be permanent. It's going to last until the day that you die.
Yep.
And that's why it makes it more expensive.
Yep.
So compare term insurance, in most cases, the overwhelming majority of cases, the insurance company will never pay the claim. They'll never pay the death benefit. With permanent insurance, if you hold that permanent insurance until the day you die, there's going to be a claim.
Good. And what, I know there's different types of whole life, and I mean, is there any of these used as savings vehicles?
Well, yeah, you can use all kinds of permanent insurance as savings vehicles. In fact, we like that aspect of it, particularly for our younger viewers out there. It's a really good way to do, the life insurance can be very versatile. So it can provide the death benefit. So in its basic form, you're providing a death benefit. But in addition to that, it can supplement all the other things that you're doing for retirement. So it can be a savings vehicle, and the cash value aspect of it can give you a lot of favorable tax treatment if you use it as a mechanism to save for retirement.
And if we go back to why someone would purchase term or permanent insurance to take care of liabilities, do other people also want to have enough money for their goals? Like, meaning if somebody wants to put their children through school, or the spouse wants to retire, I mean, do you look at that?
Yeah, of course. I mean, it's a good planning tool, because if you look at the savings that most people do for retirement are through their work, through like a 401k plan, or you're saving through maybe an IRA or something like that. Those plans and those products they're qualified retirement plans, so they're age driven.
Yep.
So you can't, by definition, with these qualified retirement plans, you can't get at these benefits without penalty until you're 59 and a half. Well, with life insurance, it doesn't work that way. You can take the money out, you can borrow it. There's a lot of flexibility with life insurance. I know in my own personal situation, I'm putting 4 children through college, and I know that in a lot of cases with my own life insurance, I would take money out of the life insurance policies, the cash value, to help pay the tuition, and then I would then eventually pay that money back.
Yep.
But that was just my own personal way of helping to fund some of the college expenses that our family incurred. But that's just one example of how you can use it for cash value.
And I imagine there's thousands of life insurance companies. How would one look to find out what would be the stronger insurance companies?
Well, the way we like to do it, and that's actually a good question, Steve, because our firm is independent.
Okay.
So we have relationships with dozens of life insurance companies, and we don't even stop there. So if we find a life insurance company that might fit a particular need, and maybe we aren't licensed with that particular company, we can always get licensed. We can always get the proper requirements that we would need to put that life insurance in place for our clients. So we can pretty much search a very large database of insurance companies to fit the bill. So what you want to look for is a couple of things. One is the strength of the insurance company. So you look at there's rating agencies out there that rate insurance companies, and that's based on the strength of the insurance company, how long have they been in business, what is their ability to pay their claims. So if you're healthy, why not go to a top-rated insurance company? The only time you would look at an insurance company that's not highly rated is if your health isn't highly rated.
Yep.
You know, maybe you have substandard health. Maybe you have a problem with your health. You know, maybe it could be a number of things. Could be, you know, diabetes or cancer or a heart problem. Could be anything.
Yep.
That would be the only time you would look at a substandard carrier.
Yep.
But for the most part, you're looking for a strong insurance company. And the other thing that you're looking for is some insurance company that's going to be strong in the areas where the type of insurance that you're looking for.
Yep.
Maybe your age,
Yep.
maybe the product that you're looking for.
Yep.
You know, there's another aspect to this with life insurance, and that is long-term care.
Yep.
Long-term care, and that's probably a subject for another show, but long-term care has been, the risk of long-term care has been covered through life insurance. Now,
Okay.
that's a very popular way to do it, and this is how we do it in a lot of cases. So what does that mean? Well, what that means is if you're, and this is popular with some of our older clients. So we just put a plan into place for a female client of ours who's going to be 66 years old. Okay, so she has, in its most basic form, life insurance, but if she gets sick and needs long-term care, she can access the life insurance benefit
Yep.
on an accelerated basis or on a premature basis. She can get at that death benefit to help pay for long-term care expenses. So in a perfect world, she never needs long-term care, and then when she ultimately passes away, her family's going to get a tax-free death benefit. But if she needs the care, and maybe she will. Her mother just died, and she was 97 years old.
Yep.
So, you know, she could live a long life, and maybe well into her 90s, she's going to need long-term care. By the way, that's where the risk is for long-term care.
Yep.
It's not so much in your 60s and 70s. People are still generally healthy, but it's when they get into their later into their 80s and even into their 90s, which is where we're seeing a lot of people living now. That's where the risk of long-term care is. And as our population ages, the risk of long-term care becomes greater. So if you're buying a life insurance policy with one of these long-term care access riders, you're actually covering two different kinds of risk.
Sure.
You're covering the risk of death
Yep.
through the life insurance, but you're also covering the risk of long-term care
Yep.
through the access rider. And you have to do that with a cash value, or as you said, a permanent life insurance product. So in the case of the policy that you and I just worked on and we just put into place, that is a universal life insurance policy.
Okay. And now, as someone gets older, maybe they don't have any more liabilities, their kids are grown, out of the house, how would one use life insurance as a tool at that point?
Well, Steve, what happens is the life insurance has a tax-free mechanism to it that just makes it a very effective tool for planning. So we have a lot of clients who have an overwhelming amount of their assets in qualified retirement plans, which means that there's a big tax bill that comes along with inheriting that asset.
Yep.
Okay, so you may be inheriting an IRA that's going to be entirely taxable. Well, if that's the case, you may not want to take distribution of that IRA in the year of the death, because it's all going to be taxable. It's going to, and that death benefit or from the IRA is going to stack on top of your income. So you're going to be taxed at a very high bracket. That's just the way that the structure of taxes are in our country. So the beauty of the life insurance, generally speaking, is that the life insurance pays a tax-free death benefit, and you're able to supplement the taxability of the IRA and allows you to be more tax efficient with how you take distributions from the IRA.
And would you ever get to a point that you'd want to get the life insurance out of your ownership, out of your estate, so to speak?
Yes,
Okay.
of course. So the reason why you would do that is if the value of your estate is going to cause estate taxes. So the taxes we were alluding to earlier with the IRA, those are income taxes.
Okay.
So estate taxes are there, like right now, the estate tax is pretty, the threshold for when taxes kick in is pretty high. It's over $5 million. Let's just say it's $5 million. So a lot of people, it doesn't matter. But for some people, it does matter. So what happens is if you have the life insurance, and this is, again, this is probably a subject for another show, but if you have the life insurance owned by somebody else, either it's owned by your children or it's owned by an irrevocable life insurance trust, or what we call an ILIT, irrevocable life insurance trust. It's because you don't own the insurance, it's out of your estate and therefore not taxable to your estate. Okay, so that's a very effective and very powerful tool, because when you think about it, you're not only saving on taxes, but you're leveraging the life insurance on top of that. So the premiums that you pay every year into this life insurance policy are being diverted outside of your estate, and then you're creating for yourself a great big tax-free benefit. And there's other implications of doing that. There's gifting, because the premium that you pay for this life insurance is technically treated as a gift. So whether you're gifting that money to your children outright to pay the premium on the life insurance, or whether the money's going into this irrevocable life insurance trust, either way, it's treated as a gift.
And we talked a lot about products today. In your organization, our organization, how do you get there from just when you meet somebody for the first time?
Well, Steve, it's all about the planning. We do comprehensive planning, comprehensive financial planning, and comprehensive estate planning. So it's not necessarily product driven. So, we don't meet with somebody for the first time and say, hey, you need a life insurance policy. It has to evolve to that. There's a lot of different, we're just scratching the tip of the iceberg today on uses for life insurance, because there's dozens of them. And over my career and over your career, which both of us have been in the business over 20 years. So, and when I started in the business, that's all I did is put life insurance into place, and you started the same way. So, you and I, have lots of stories with how this all happened and how this all evolved. But where we are now in our careers is it becomes part of the plan, part of the overall plan. So we have a couple of, just to kind of put a little plug in here for us, we have a couple of public events coming up. We've got some events that are scheduled in the coming weeks where we talk about some of the things that we talk about here on our show, as well as we sometimes we dig deep into retirement and Social Security. But if you're interested in getting tickets to an upcoming event, give us a call or send us an email. We'll put the information up on the screen. You can send us an email. You can give us a call, and we'd love to see you at one of our events.
Well, for Jeff Bush,
Yeah.
this is Steve Jablonski with another show, and we will see you all next month.